Chairman Johnson, Ranking Member Crapo, and members of the committee, I am Richard Swanson, President and CEO of the Federal Home Loan Bank of Des Moines, a federally chartered cooperative owned by nearly all of the 1,200 financial institutions in the states of Minnesota, Iowa, Missouri, North Dakota, and South Dakota. I appreciate the opportunity to speak to you today on behalf of the Council of Federal Home Loan Banks. More than 7,500 financial institutions of all sizes, including commercial banks, savings banks, credit unions, insurance companies, and CDFIs, are members of the Federal Home Loan Banks. Most of them are active mortgage lenders who use advances from their Federal Home Loan Bank to help fund loans that can be held in their own portfolios, such as adjustable rate mortgages. With almost $500 billion of outstanding advances today, providing collateralized funding to our members is our primary business line, and one that needs to be preserved. Most lenders have difficulty managing the interest rate risk associated with holding long-term fixed-rate loans on their balance sheets. As a result, they typically sell those loans into the secondary market where they're pooled into large mortgage-backed securities. When selling their loans into the secondary market, the smaller lenders face particular challenges. This morning I will focus on two of these challenges and the role the home loan banks play in helping small lenders deal with them. The first challenge for smaller lenders is one of volume. How can a few loans from many lenders be efficiently gathered and sold into the secondary market at pricing for the combined volume that is competitive with the large lenders? Building upon our long-standing business relationships with members, the home loan banks developed mortgage programs to help smaller lenders meet this volume challenge. We purchase mortgages in small volumes from over 1,600 of our members at pricing comparable to what the large lenders were getting from Fannie and Freddie. Initially, we held all of these loans as long-term investments. Now, we are also leveraging the scale of these mortgage programs to facilitate the sale of mortgages by smaller lenders directly to secondary market buyers, but at prices reflecting their collective volume. In the reformed secondary market contemplated by S. 1217, Fannie and Freddie will no longer dominate the aggregation, pooling, and securitization functions. These functions will be distributed among more parties, potentially including the home loan banks. By aggregating and pooling loans in sufficient volumes for issuance in mortgage-backed securities, we could further improve secondary market pricing for our smaller members. The second challenge for smaller lenders facing the secondary market relates to value. Smaller lenders tend to originate mortgages that perform better and are therefore more valuable to investors. How do smaller lenders get paid for this added quality? Our mortgage programs allow smaller lenders to retain a portion of the credit risk of each mortgage they sell to us. If their loans perform well, the members receive a credit enhancement fee to reward them for the value of their loans. Over the past 15 years, the home loan banks have purchased more than $200 billion of mortgage loans with this risk retention feature. With our members' skin in the game, these loans have experienced total losses of less than 15 basis points, or less than 1/7 of 1% of the original principal amounts. This is an extraordinary result. In the secondary market contemplated by S. 1217, any pool of mortgages securitized with the backstop government guarantee would require private capital insurance covering the first 10% of losses. If this private capital loss coverage is provided in a competitive market by multiple parties, we could seek bids for that coverage on pools of higher value mortgages originated by our members, which should command a lower premium. Members might also elect to retain part of the risk on mortgages they sell, as they do under our portfolio mortgage programs. We have the experience to manage such a skin-in-the-game program, which may enable us to negotiate an even better price for their private capital guarantee, or a credit enhancement fee to members if their mortgages perform well. We are pleased that S 1217 recognizes the importance of lenders of all sizes in a reformed housing finance system and contains specific provisions to assure competitive and reliable secondary market access for smaller lenders. We also appreciate that the bill provides different alternatives for the home loan banks to serve their members as the housing finance system evolves. We stand ready to perform that mission. Thank you.